Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast. Good morning. It's Wednesday, the 20th of August. I'm Stephen Carroll in London. Coming up today, a record-breaking run in global stocks loses momentum after a sharp sell-off in big tech names. Why ousting a CEO has never been so expensive. Inside the golden parachutes, retention bonuses and search fees driving up the cost of change at the top. Plus, we have a special report on how over-tourism and climate change have created a dangerous feedback loop that threatens southern Europe's economies. Let's start with a roundup of our top stories. Global stocks have paused after a record-breaking run as concern grows that the rally of recent months has advanced too far and too fast. The S&P 500 closed down 0.6% yesterday, while the Nasdaq 100 slid by 1.4%, with Nvidia leading a retreat in big tech. The AI powerhouse is due to report earnings next week. Darryl Cronk, CIO for Wealth and Investment at Wells Fargo, says he remains bullish on the tech sector because of their earnings growth.
You've got to go where growth resides, and there's just no doubt that that's where the growth is. You saw it in the latest second quarter earnings numbers. You take the seven largest stocks, their earnings growth were 29%. If I take X those, earnings growth was like 3.5%.
Wells Fargo's Darryl Cronk speaking to Bloomberg earlier as traders are firming up bets on a September interest rate cut from the Federal Reserve. Newly released transaction data shows US President Donald Trump bought bonds worth at least $104 million since returning to the White House. The bond investments include a raft of American companies affected by sweeping policy changes championed by the president. The Bloomberg Billionaires Index estimates Trump's net worth at $6.4 billion. But unlike his predecessors, the president has not divested or placed his assets into a blind trust. Trump's business empire is instead managed by two of his sons and operates in several areas that intersect with presidential policy. European countries are developing a plan to send British and French troops to Ukraine as part of a potential peace deal between Kyiv and Moscow. Leaders are said to be looking to leverage President Trump's support for a package of security guarantees that would involve European boots on the ground with possible US air support. Here's what the US president told Fox News.
When it comes to security, they're willing to put people on the ground. We're willing to help them with things, especially probably if you talk about by air, because there's nobody has the kind of stuff we have. Really, they don't have. But I don't think it's going to be a problem. I think if a deal is made, famous last words, right? But I think if a deal is made, I think Russia's had it. They've all had it. And for a very extended period of time, I don't think there'll be a problem. But there'll be some form of security. It can't be NATO because that's just not something that would ever happen. He couldn't.
Those comments on Fox News came as Bloomberg learned Trump called Hungarian Prime Minister Viktor Orban on Monday after European leaders pressed him to intervene in Ukraine's stalled EU membership bid. EU leaders say Ukraine's membership is part of broader security guarantees, but Orban has described the idea as unnecessary and dangerous. The UK government faces legal action after a council won a court battle to stop a local hotel being used to house asylum seekers. The Bell Hotel in Epping, east of London, has been at the centre of violent protests in recent weeks. District Council leader Chris Whitbread says the decision showed the government cannot ignore planning rules.
We always knew the Bell Hotel was the wrong location because of its close proximity to schools and other parts of the community. It was never going to work out. This is not a victory today. This is a ruling for common sense.
Whitbread's success raises questions over the government's practice of using hotels to house asylum seekers across the UK. The Labour government's first year in office has seen illegal crossings of the Channel rise to a new record high, stoking public anger about controlling migration. Thousands of firefighters, aided by soldiers and aircraft, are continuing to tackle wildfires across Spain. Although temperatures across the country have begun to drop in recent days, Spain is still confronting one of the most destructive fire seasons in recent decades. The fires have killed 4 people and burned almost 1,500 square miles of land, equivalent to an area more than twice the size of London. The number of CEOs being forced out of their jobs is on the rise, and it's expensive. One analysis has found 134 CEOs were pushed out last year in the Russell 3000. Bloomberg News consulted with compensation consultants, PR experts and executive search advisors to try and find the true cost of firing a CEO. Bloomberg's James Wilcock has more.
Get your calculators out. Bloomberg estimates the median compensation for a forced-out US boss was $6.2 million. The sign-on fee for their replacement, another $9 million. And then there's the new higher pay packet. The 100 top-earning CEOs at companies with more than $1 billion in revenue are paid 22% more than last year, according to pay consultant Equilar. That's a median of $31 million. So factor in the millions in lawyers, plus payments to the rest of the board, and the whole exercise is a lot more expensive than showing the boss the way to the exit. In London, James Wilcock, Bloomberg Radio.
Those are your top stories on the markets. We're watching the MSCI Irish Pacific Index down by 1%. The Nikkei in Tokyo is 1.6% lower. The Hang Seng Tech Index mirroring the fall that we saw in the Nasdaq yesterday, down 1.3%. European stock futures also pointing lower by 0.7% this morning. The Bloomberg Dollar Spot Index is a tenth stronger. The euro trading at 116.34. And looking ahead to the Wall Street session, Nasdaq futures are pointing lower by 0.6%. Now, in a moment, we'll dig into the tech stock sell-off, plus bring you our reporting on how over-tourism and climate change in southern Europe are creating a dangerous feedback loop for economies there. But another story I wanted to mention this morning, and a good point raised by Bloomberg's James Tarmy. Watching children squabble is annoying unless it's about inheritance, and then it turns out it's theatre. So he's been watching about the upcoming Netflix series about the Guinness family set in the late 19th century in Ireland and focusing on the 4 children of Benjamin Guinness over the beer empire. Now, the difference to the likes of Succession is that most of the kids don't actually want to run the business, they just want the money. James writes, this is coming at a time where there's increased interest in the Guinness clan. There are also 2 non-fiction books about them coming in the next few months. Very interested to see how the series turns out, though. It's created by Stephen Knight of Peaky Blinders fame, so that ought to put an interesting spin on this for an audience viewing it around the world. I'm always curious at this as well, whether or not they're going to get the accents right. I have to say credit to the creators of the Sing Street musical, a film that's recently been staged in London over this summer, which I saw, which is essentially full of people with accents like mine, and they did a great job. Lots of them, I was very surprised to find out afterwards that they weren't Irish, so I will be applying a similar level of standard to this Netflix series coming up as well. That's due out to be released next month. Something to look forward to for your autumn culture calendar. Well, let's dig into some of the bigger market moves that we have seen today. Tech shares in Asia joining the sell-off that we saw on Wall Street yesterday. The Nasdaq finished 1.4% lower, futures pointing to further losses at the open later on Wall Street. Our Markets Live executive editor Mark Cudmore joins me now for more. So, Mark, is this investors realising that valuations are stretched, or are we just looking at an August moment on markets?
I think there's a whole host of issues. I think it's a really ripe reason for tech to sell off. I think we've got Jackson Hole this weekend, where the risk coming out of that is higher long-end yields. And because of the incredible capex cycle we've seen in AI, they're higher duration assets than they were before, so they're more vulnerable to move in long-end yields. And I expect whatever happens within a week or two of Jackson Hole, we'll see higher long-end yields, because either Powell folds to administration pressure, in which case you see a twist steepening of the curve, or he pushes back against administration pressure, in which case the administration will double down next week, which will again alarm the back end of the curve. So you're going to see AI suffer from that problem of higher long end yields. You do have lofty valuations. You've got retail kind of trader seasonality. This is the time of year where they step back a bit, August and September. Citadel came out with a note about that last night, of course. We've generally at the kind of the peak of the hype cycle in AI relative to the impact cycle. It takes a long time to feed through to productivity. As companies adopt AI, it's expensive to adopt those transformations, so you get a dip in productivity at that moment. We've got NVIDIA earnings next week. We've already priced it in to be an amazing beat. It will be an amazing beat. Earnings have been really good for all the AI companies. We've had several weeks to price that in for NVIDIA. It's more than fully priced in, so everyone's realising it can't really be a positive surprise. It can only be a negative. I think we're seeing some rotation because small caps earnings have been really good. We've got the threat of chips tariffs coming again from Trump. I'm not sure anyone really believes that, because he always says it's within 2 weeks, but it might happen. And we've got the US administration inflation directly extracting revenues from companies. We've seen it, with both Nvidia and AMD. And last week, in a little noticed comment from the White House, they said they're looking to expand it to other companies. That's a direct taking from revenues into the profit margin of companies. So there's loads of reason for AI tech stocks to sell off. I'm an AI bull longer term, but this is the first time in a long while AI I'm very worried about.
Well, is this something that we need to get used to, essentially? Is that there will be this long gap that you're talking about between the investment and the productivity gains coming through? So does it set us up for a rough ride for these stocks for the coming months?
Yes. So we have a J curve of productivity, which is what we get in technology, which is, as I said, it's normally a dip in the short term as companies realize they need to adopt this technology. And that's the kind of phase we've gone into now. Everyone's kind of going, we can't have our heads in the sand anymore. Ultimately, I actually think AI will be transformative, and I think it will be a massive global productivity boom. And over the coming years, I think it's a reason to be very bullish global stocks. But I think that the valuations of US mega cap techs have priced in just several problematic things. One, accruing almost all the benefits of this productivity boom, accruing them very soon, and it's focused on very few stocks. So I think and it's fully kind of priced. So I think it's US AI tech sector in particular that I'm worried about, and I think it's going to be a problematic few weeks ahead. As I said, Jackson Hole earnings, Nvidia, the chance of more chip tariffs. Then we've got, of course, the macro data at the start of September, which is really going to decide what the Fed does. But they're in a quandary because they're being forced by the administration to have too easy policy relative to what economic orthodoxy would suggest. And that just means that everyone believes the inflation problem is going to get worse, which is already quite bad. And that just means higher long-end yields. And these companies are higher duration assets because they spent so much on the capex cycle. So they're really vulnerable over the next month.
Well, just in terms of Jackson Hole, I mean, there are traders, putting bets now on a bigger than 25 basis point cut in September. Do you really think that Jerome Powell is going to be able to steer much in either direction on Friday?
I think he'll try to keep his options open. The theme of the conference is about the labour market, and I think if you look at the full title, it tees it up to kind of talking about, look, hey, the labour market's cooling, but we're also seeing a decline in supply, and that's why we're seeing unemployment rate not pick up, and everyone knows that you don't tweak monetary policy to address a supply side problem that's causing so therefore if there's a labour market decline in the labour market supply because of the crackdown immigration, well then cutting rates won't be the first thing to fix it. And it's also not clear the labour market's completely collapsing. Non-farm payrolls was disastrous, but claims are still very, very low. So I think the labour market's very much cooling, but it's cooling from a very hot level. Is it going off a cliff? No, it doesn't seem like it. And meanwhile, inflation is very, very high. I think the Powell knows that economic orthodoxy would say there's no way there should be a cut next month, but he might feel, I kind of feel pressure to. He won't be cutting unless the data at the start of September gives him the cover to do so. Or I don't say that for the whole committee, it's not just on him, but I think enough committee members will feel the pressure and will shift to a cut if the labour market data at the start of September is very weak and inflation data a few days later isn't, very, very problematic. I just don't see that outcome happening. So I think it's going to be very, very hard to see a September cut.
Okay, Mark Cudmore, our Markets Live executive editor, thank you very much for joining us and talking us through some of what we're seeing on markets today. Stay with us. More from Bloomberg Daybreak Europe coming up after this. Now, firefighters in Spain are continuing to battle several major wildfires in the northwest and southwest of the country. Spain's Prime Minister has called for a new response from the public and private sector to what he describes as the climate emergency. Today, Bloomberg's looking at how over-tourism and climate change have created a dangerous feedback loop that threatens some of Southern Europe's economies. Our Europe climate reporter Laura Milan is with us now for more. Laura, good morning. How is climate change shifting tourism patterns then in Southern Europe?
So Southern Europe, the European Mediterranean, is warming very fast. It's a climate hotspot for lots of reasons. And what our story looks at today is that the tourism season in the Mediterranean is getting longer. So tourists are not just traveling in the traditional peak season of July and August anymore to go to their beach holidays. They're traveling also in April, May, June, September, October. So the tourism season is getting longer, but actually what we're looking at is the fact that the traditional peak months in some places, in some hotspots for beach tourism and hot temperatures, peak season is getting less busy, slightly less busy. And then the other interesting thing that we found is that even if the tourism season is getting longer, the weather is becoming more unpredictable. So if you're traveling to the Mediterranean for your beach holidays in May, you might see extreme rain, for example, and the peak season is becoming more unpredictable as well, because as you were seeing just now, we're seeing wildfires everywhere, heat waves, obviously, and all sorts of extreme weather events made worse by climate change.
What does this shifting pattern, though, mean for the economies that rely so heavily on tourism and also for the environmental impact of visitor numbers?
So for the economy, as we look at the numbers, we see how, the coronavirus pandemic obviously kept everyone at home, and there was a big dip in tourism revenues for all of these countries. So we're talking Portugal, Spain, France, Italy, Greece, all seeing huge dips in tourism revenue after the coronavirus pandemic. But what we've seen is that rebounding really strongly over the past few years. So tourism GDP, we've looked at tourism GDP, we've looked at tourism employment and revenues from foreigners in all of these countries I just mentioned. They've gone up to levels higher than they were before the pandemic. So from an economic point of view, this is good for these economies. They've increased their employment and the revenue from foreigners. But actually, when we look at the environment, we see that these additional amounts of tourism, we're talking millions of people here traveling to these destinations, which were already crowded before the pandemic. They're adding new pressures to the environment. So we're seeing all of these places strained for water resources, especially because the Mediterranean is becoming drier as it becomes hotter. We're also seeing a struggle for power. So we're seeing in some places power cuts or power becoming more expensive. And we're also seeing natural places, pristine beaches and forests becoming crowded with people, more polluted, more noise, and more danger of wildfires as well.
So how are authorities then dealing with this tension?
In the places that we've looked at, so this is Ibiza in Spain, Alentejo in Portugal, and Trentino in Italy, we're seeing very different approaches because the places we looked at are different. So in Ibiza, which is a traditional tourism beach destination known for clubbing as well, authorities are, I would say, overwhelmed. They are trying to deal with the issue by promoting what we call the shoulder season, so the months right next to the peak season, to July and August. But actually, the results that we're seeing from these policies of trying to balance it out and not have all the pressures of over-tourism happen in just 2 months, but spread it out, it just means that more people are coming in. So the amount of people that are choosing not to travel in July and August does not compensate the amount of people traveling in other months. So in short, you have more tourism coming in, more pressure. In Portugal, we've seen a move where authorities and companies in the sector try to move some of that tourism further north to alleviate the pressures in places like in the south, in the southern areas. And we've seen the same pressures coming to the new places where they're trying to promote tourism. So in short, the problem is kind of moving north with the tourism. And in Trentino, in Italy, that trend is very nascent. So the other thing we've looked at is people choosing not to go to the beach, but go to the mountains as they look for cool weather and lower prices. But these problems are coming with them as well. So we've seen authorities try to do a range of measures from, limiting cruise ships to imposing tourist taxes. But none of this is really solving the core problem, which is over-tourism plus climate change, adding extreme pressure to places that were already really pressured by tourism.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.